Thank you so much for joining our webinar today on how to solve your time series and data analytics challenges and why you need a time series database. My name is Justin Fry. I've been working with John and Louis on the presentation for a while. I think you'll find it very interesting. Some housekeeping issues while people join the webinar today. We'll have a Q&A session at the end. Please feel free to ask questions at any time using the Q&A button at the bottom of the Zoom interface. If you should have any technical issues with the webinar, please use the chat button at the bottom of the Zoom interface to let me know. And now about our speakers. Louis Lovas is the Director of Solutions at OneMarket Data. Louis' responsibilities include delivering targeted solutions for quantitative research and trading systems. Louis brings over 20 years of experience in developing cutting-edge solutions for financial markets. Prior to joining OneMarket Data, Louis was the Chief Architect of Apama, the event processing product line from Progress Software. John Kellow is a Product Manager for Data Products at OneMarket Data. John joined in 2007, having previously worked with Leonid, OneMarket Data's founder at Goldman Sachs. Prior to that, John worked for a futures hedge fund called Mint Investment, and that's where he started working in the financial industry. John has around 30 years of experience in financial markets at this point. As we designed the content for this webinar, we ended up having two parts. First of all, the first part, one of the 5 core operations on time series data we wanted to show today, aligning, interleaving, filtering, sampling, and stitching. In part 2, we're going to have some use cases to illustrate actual operations. John's going to look through alignment, interleaving, filtering, and sampling using some actual data, using Jupyter notebooks that then will be made available later after the webinar. Louis is going to get into stitching and some of his favorite topics around futures. Thank you so much for your interest in OneMarket Data and joining the webinar today. Now over to John.
Hi, thanks, Justin. So OneMarket Data was founded as a software company in 2005 by industry professionals that had a lot of experience working with financial data. It originally started off as just a software company. So it's a tool, our flagship product, OneTick, is a tool that you can capture real-time data feeds. It's a database server, so you can store the captured financial data. You can load historical data, and then it has a very rich set of analytic functions for retrieving and analyzing that data. So customers would buy the software, but they would bring their own data. In 2008, we started offering some reference data to our customers. So even though they were bringing their own data, they still needed information about splits and stock dividends and ticker changes. We got into the data business full-fledged in 2012 when we launched our OneQuant data product. And that's really a global equities product master, corporate action database, and daily official closing prices. And we really aimed that at 2 segments of the market. One was some of our smaller customers who didn't have an equity product master. Maybe they were a small startup fund, but we also aimed it at the very large customers that they want to do global equity research, global portfolio research. So we still offer that product, and that's a great research tool. You can get daily prices for the US back to 1970 and for all global stocks back to 2009. So in 2015, we started getting into the tick data business. We launched our OneTick cloud platform, and that's a tool that provides tick data hosted on the OneTick software. So for our software customers, they're able to connect their software directly to our shared servers. And in a matter of minutes, they can have access to 20 years of tick data. But for our non-software customers, we do offer downloads. So we're a traditional data vendor. You can just buy files from us. And in 2015, we also acquired a company called Tick Data, which they have a long history of providing that. So that really expanded our data offerings. And that brings us to today. We just keep adding more markets, and we're a pretty comprehensive provider of tick data. So if you need data, we're one of the people you should consider talking to. So talk just briefly about the data analysis pipeline. So whatever kind of project you're working on, you're going to start off with raw data that you get from a vendor like OneMarket Data or Bloomberg or Refinitiv or Tick Data. And then you're going to do some pre-processing to it. So you need to get your data set created, lined up for your analysis. And once you have the data pre-processed, the calculations are pretty straightforward and easy. And you might be doing some traditional quant analysis. That would be things like building a multi-factor risk model or doing a back test or a pricing model. But we're getting a lot of interest now from people who are trying to apply machine learning techniques into financial data. So whether you're doing the traditional analysis or you're doing machine learning, the pre-processing part is really key, and it's really the same for both paths. So everybody's starting off with the same raw data. It's really what you do with your data set, getting it set up to have a successful project that can make the difference. So that's what we're going to be focusing on today. We're going to be talking about this step of taking your raw data and getting it ready to do some sort of analysis. So we've identified 5 core operations that are going to cover most of your pre-processing steps. We think maybe about like 90% of it. And these core operations are key to getting your data set up in the way you need it. And depending on what you want to do, your pipeline is going to involve one or more of these steps, and it might involve the same step multiple times. But if you think in terms of these core operations, I think you'll be able to break any complex task down into its component parts. So what we're going to hope that you take away from this webinar today is, if you're an experienced quant or somebody that's been working with this data for years, hopefully it will help you think about your own data processing pipeline. And if you're new to the financial data space, we're going to hopefully get you on the path to working with the data. So our first key operation is called aligning. So first of all, when we're talking about the data, tick data, it means the prices that are published by a stock or a futures or an options exchange, and they're coming out in real time and they're captured and saved. So we're talking about the historical record of that data, and it's a huge volume of data. So the first challenge is, if you're trying to compare data from 2 different stocks, or data between a stock and the quotes and the trades of one stock, you're not going to have the same time stamps on the 2 data sets, because the trades happened at different times. So if you want to compute a spread, if you want to compute a ratio, you need to line up your 2 data series. And one of the common ways to do this is you take one series, and for every tick in that series, you match it to another series. So you take the latest value, and you may need to repeat values from the second series because they're not updating at the same frequency. But once you've repeated your values, you've matched your latest values, you have essentially a traditional tabular data set. You have columns of data for different securities, and now it's really easy to do whatever kind of computations you need. So that's the aligning step. The next one is called interleaving. And instead of making rows of data, this time you need to put all your data in one column. So the data series will have things in common like prices and sizes. And so we're just stacking it up in time. And there's a couple of reasons why you might want to do that. First, you might want to create a composite view of the market. So in many countries, you can trade stocks in multiple venues. So you might want to look at across venues and see, where's the total liquidity. So I want to take 2 different series from 2 different venues, and I want to merge them together so I can see like one big picture view. And we're going to look at a particular example of that. Okay, our next operation is filtering. We don't want to necessarily look at every single tick in our data. We might be interested in only the ticks that satisfy certain conditions. When we're looking at trade data, there's a lot of conditions that occur with every stock trade. It'll tell you, is this part of the continuous trading? Is it part of an auction process? Is it a late reported trade? So we might want to apply some criteria and cut down our data set. So this is a real key step to zoom in on the data and focus on only the part of the ticks that matter. So it's a pretty straightforward step, but almost all of your preparation is going to involve some level of filtering. Next is sampling. So we might not need to look at every single tick. We might want to cut down the frequency, only look at data from, say, every minute or 5 minutes or something like that. We can still capture the intraday moves, but we have a lot less data to work with, and that means we can look at longer histories or more stocks. So this is a little bit different from filtering because we're just looking at the data at fixed intervals. Frequently, the sampling step is preceded by a filtering step. So we'll filter the data and then we'll sample it. And finally, our last operation is stitching. And this is where we take several short histories of data and we combine them to create one long history. So this is a little bit different from the interleaving because these series are not overlapping in time. We're taking sections of data, putting them together to make one long history. And there's two reasons we would typically do this. First, for stocks, there's ticker changes. So a company changes its name, they change their stock ticker. You need to pull those histories together because it's the same company and you want to have a multi-year long history to do an analysis. And then the second example, which is what Louis is going to talk about today, is futures data. So futures trades in individual contracts and they expire, and then there's another contract and another contract. But we often want to take that data, put it all together so we can have one big long history. We can view a stock index future, a crude oil future or something with a multi-year history, just like we would look at stock data. So Louis is going to give us the example of that. So those are our 5 core operations. Now let's take a look at some examples of these 5 operations. So I've pulled out a use case for each one of them. I'm using the data from our OneTick cloud, and I think we're going to be able to share this. So hopefully at the end of this, you will be able to contact One Market data, and we'll share some of this sample data. You can play with it yourself. So for the alignment step, I'm going to calculate a spread. And to make it more interesting, I decided to do a spread between a stock trading in the United States and one trading in London. So in the US, we have something called ADRs, American Depository Receipts. And that's a way of US investors can get exposure to foreign stocks without having to go to a foreign market and deal with currencies and all of that other issue. But it is a foreign company, so it is trading in its native market. So I decided to look at AstraZeneca. It has very active common stock in London, very active ADR in the United States. And this example is interesting because there's also the currency factor. So we have to pull in a third series, which is our currency rates, and do a conversion. So we're going to line up 3 different series and we're going to calculate a spread and we're going to see, okay, how well does this ADR track its common stock? So let's just take a look at the raw data. So there's the ADR trading in the US throughout the day. Now, the London market's going to close at 4:30 p.m. London time, which is 11:30 New York. The New York market opens at 9:30. There's pre-trading from 4 a.m. So from 9:30 to 11:30, there's very active trading in both markets. So there's the stock trading in London, and this is kind of like that run up into the end of the day that's occurring, in the morning of New York here. And then finally, we have our spot rate. So the currency is moving around. So there is some currency exposure in this spread. Now, we're going to use the Pandas data library. That's a very popular data science framework. And to do this kind of alignment, Pandas calls it a merge as of operation. In OneTick parlance, we call it a join by time. So if you're a OneTick user, this is join by time. Pandas, it's merge as of. So we just use the merge as of function. We pick 2 series. One is called the left series or the leader, and I'm going to choose the ADR that has more granular timestamp, and it seems like it's a little bit more active. And then we're going to join it to the stock. So I'm going to do 2 steps. First, I'm going to do the ADR and the stock, and then I'm going to do that data set with the currencies. So I'm joining with my index, which is time, and there's going to be common fields like price. So Pandas will add a suffix to that to disambiguate. Now, one thing I recommend when using Pandas and doing something like this is have your timestamp as both a regular data column and your index, because after the join, if it's a regular data column, you'll be able to see very clearly where the data came from. So we do our 2 steps, and now we have our combined aligned series. And the thing to notice right here is here are the timestamps from the original series, which is the ADR. So you see they match exactly. So for every tick that comes out from the ADR data, now we've aligned it to the common stock and we've repeated values. So this one isn't, trading at this time quite as rapidly. So we're just repeating this value. And then finally here we have our currency. And so you can see when each of these things updated. So we have our price, of our ADR, price of our common stock, and then we have our currency rate. Now this, you'll notice this price is really large. That's because it's actually quoted in pence. So we have to divide by 100. And then 2 ADRs are equivalent to one stock. So we also have to divide by a factor of 2. So once we've built this set, now calculating the spread is just like, calculating something in a, any Excel spreadsheet or a MATLAB array or anything like that. We can just use a regular formula. So I'm just going to first convert my price and then just subtract it. And there's our result. So you can see now we have prices that are very comparable, but the ADR is trading at about a 60-cent premium to the stock. It's about about 1%. And it's pretty consistent, but it moves around. So let's just graph it. And there we see it's pretty flat. This would be the early morning, pre-market trading in the US. There's a few dislocations. If we were, doing this as a research project, we would dive into this a little more detail. We would say like, okay, what was going on right here? Is this maybe a trade we should exclude from the analysis, or, maybe it's a real thing? And then you can see how things get more active when both markets are open. And then it looks like the spread starts, tightening up as we go throughout the day. So that's aligning data and doing computations. Next, we're going to interleave. So in this case, we're stacking up our data, and I'm going to show making a little composite. So in Europe, we have a lot of different trading venues. So I picked out Vodafone, and we found, about 15 different databases, I think, that had some activity. So I'm going to show just taking kind of the top 3 venues. So it would be the London Stock Exchange, and then 2 of what are called multilateral trading facilities. They're both owned by the Chicago Board of Options now, and they're referred to as the CBOE, BXE, and CXE facility. So let's just take a look at our raw tick data again. We have our price, our size, where the trading is happening. So this is the data. These are all coming from the London Stock Exchange, XLON. And then we'll just take a look at the other series. This is the BXE series. And again, this was originally called BATS Europe, and it was acquired by CBOE. And so there's our venue for this. So we have these 2 different series. We're not going to align them like we did before. We're going to interleave them. We're going to stack them. So most of the activity here is just the count. We have about 9,600 ticks from LSE, about 3,000 from BXE, and about 6,000 from CXE. So there's significant activity in these other venues. We want to be able to see all of this and get a clearer picture of how the market is trading this stock. Now, this operation in Pandas is called concatenation. So it's actually a 2-step operation. We concatenate, but then we have to resort by time. In OneTick terminology, we call this operation a merge. So we just do our concatenation. We can do all 3 series at once. We resort our index. And now let's take a look at the data. And you'll notice here, now the data has been interleaved. So we have a trade that came from London, a couple of trades that came from the CXE, and then a trade that came from the BXE. So we've now made our own composite out of these 3 markets. We can do this for any kind of country in the world where we have this type of trading. It's such a common operation, though, that for Europe, we actually have a data set where we've done this operation already. And so I pulled the Vodafone data out of our pre-computed European composite database. And these are all the venues where trading occurred. These are the MIC codes for those venues, and there's the volume. So you can see it's really spread out through like a lot of different types of trading venues. Obviously, the London Stock Exchange is still big. There's a lot of kind of off trade called OTC trading that takes place. And then, there's some sizable venues like the ones we just looked at, the CXE and the BXE. So that's interleaving data. We make a composite. Another way you might want to do this is if you wanted to compute your own index, you want to do a calculation across many stocks. So I could take a basket of stocks, 100 stocks, 500 stocks, interleave them, and then I can perform, my own index calculation off of that. Okay, let's talk about filtering. So we only want to look at sometimes certain stocks or certain ticks. There's a lot of conditions that go with the ticks. We might want to focus on, big trades, small trades, I don't know, many different criteria. So I'm going to show a very simple example of filtering. In the US, stocks typically trade in blocks of 100 shares. That's called a round lot. If it's a less than 100 share, it's called an odd lot. So in the past, the odd lot trades were handled a little bit differently. You might get a worse fill price. You might get a delay in getting your trade executed. Now everything's done electronically, so there's probably not much difference, but all of those less than 100 share trades are flagged with a special condition code. So we're just going to take a look at that and see, like, okay, how much of the activity is coming in, the small size trades, and how much of the activity is coming in the larger trades. So I'm going to filter it and create two series. I chose Apple, which is one of the most common stocks in the US, and it was for one day. I think it was November 15th. So there were more than 500,000 trade ticks for Apple on that day. And the condition code for an odd lot trade is I. So we're just going to do a little filtering on that, and this is just some overall statistics on our data. So you can see 564,000 trade ticks. Each one of those represented some kind of update. So pandas, the filtering is very easy. You can just supply a criteria. So I'm just using the contains method. The conditions are a string. There can actually be 4 different characters that you can have. So we just want to match that I string, that I character is found anywhere in the condition. In OneTick terminology, you would just stick what's called a where clause onto your query, and you would just put the criteria in the where clause. So from my original data frame, I made my the odd lot trades and then the regular trades. So if we just look at how they break down, actually almost 75% of the trade ticks were odd lot trade ticks. Only about a little over 25% were the non-odd lot ticks. So, quite a lot of activity. There's some debate about what that means. Are those small trades due to retail investors? There's a lot of apps now where people can trade one share at a time, or is it more because of computer algorithms and algorithmic trading? So there's some debate about what that means. But we sum up the trades, we actually look at the volume. So I'm just going to use the sum operator from pandas. We can see that even though we have all those ticks, they're just for very small sizes, obviously. So the total volume is just small. Most of the volume is coming from the trades of 100 shares or over. So let's just take a look at the histogram of those odd lot, and we can see very heavily weighted to the small sizes. So this would be less than 5 shares. So I don't know. We can do a lot of analysis diving deeper into this, but this is just a simple example of filtering and how we start picking apart our data set and focusing on little things. And the insight we get from this is that in a very popular stock like Apple, there's lots of very small trades happening throughout the day. And then the fourth case that I'm going to show is the sampling. So now we want to cut our data down and we want to look at maybe only every minute. There's a lot of functions that can do this in pandas. It's such a common operation that we actually offer a data set where we've taken the data and we've sampled it at 1 minute intervals. And we've been very careful about constructing this data set in such a way that you can take these 1 minute samples and you can turn them into larger samples, 5 minutes, 15 minutes, whatever you need. And this is often referred to as bars, from like the bar charts that people make, where you put a little bar and that shows you for any interval, what the starting value, the ending value, and the high and the low. So our bars include that kind of aggregation, the highest value during the interval, lowest value, but also some other things like the volume weighted, average price. So taking Apple now we can look at 3 months at a time, and we can still see kind of the intraday moves, and we can see the big broader picture, but 3 months of 1 minute bars are only 30,000 ticks versus 500,000 ticks for if we look at every single tick for the day. And obviously we have that huge volume of very small trades. So by using our bar data, now we can get the intraday data, look at it at a very long range, or we can look at, many stocks, and it's just a faster, more efficient way to look at the data. And a lot of our customers, want to work with bars and not necessarily every, tick by tick data. So those are our four kind of core operations. Our last one, as I mentioned, is stitching. And I'm going to turn that over to Louis, and he's going to talk more about the futures market and how we stitch together individual contracts and we create a very long history. And that's an essential part of any kind of data analysis when you're talking about futures. So I'm going to turn it over to Louis now, and he'll continue from here.
Thank you, John. My part, I'm going to talk specifically around the last sort of data preparation step that John described, called stitching. And that is one of the most primary functions in data preparation that would apply to the derivatives market of futures. And that has to do with the fact that contracts have a lifetime or a lifespan, otherwise known as the expiration, which could be typically like a month or 3 months. It has a life for that. It trades in quotes in that life, and then it simply ends at its expiration date. But when you want to look at much more long-term history of that, the highs and lows of the history, the past markets, the past contracts, you want to be able to see that in a continuous sense. But before I do that, though, I just want to do a little bit of introduction here just to get terminology. We're on the same page with terminology. Probably the most common thing is what's known as the front month and the back month. The front month is that currently trading contract with its expiration coming up next. That is the one that is the top of the list when you look at any sort of ordered result of contracts by expiration. And the back month is simply the next in line, right? So you might have a March contract, and then the next in line would be the June contract. That's the case when the contract's expiration goes further than a month. And many data providers or data services like Bloomberg or Refinitiv, others, they create sort of a common terminology that will represent what's known as that front month contract, like C1 or ES1 or ES2, for the, those first two for the front month, ES2 for the back month. That it is in effect a synthetic name that represents the actual traded contract on that exchange. Like those two examples that you see there, the E-mini September 2023 contract is ESU, U being the month of September, 3 being the year 2023. That would be trading quite heavily prior to its expiration in September, but for that month, it would be known as the front month contract. So I just want to make sure from a terminology point of view, we're all on the same page, because I'm going to sort of talk about this in a little bit more detail when it comes to what it means to do this sort of data preparation, pipelining, stitching for doing what's known as continuous contracts, rolling them. And this concept of continuous contracts is really where you're splicing or stitching these disparate contracts together, where you would have, as I mentioned, like this, the March contract to the June contract to the September contract to the December contract. These things do trade simultaneously, they quote simultaneously, but when you want to look at this data over a long time horizon, you really want to sort of stitch them or splice them together, and you want one contract to roll into the next one. And that's a very common type of capability when it comes to futures, and pretty unique to the futures market, actually, as well. And what it does is create this sort of forward curve of through the time horizon. You can look at the highs and the lows on that curve, the actual price itself, and you can look for, as that mentions, this concept called contango and backwardation, which I'll talk about in a moment. When you want to roll or splice these contracts, what it means is you're actually replacing one contract, what's known as the front month, with the next contract, which will then become the front month. And many data providers or vendors provide this as a service, as I was saying, like ES1 or with our OneTick cloud data. We provide this as well, that sort of synthetic name. You also have the ability to do this yourself. If you understand how the analytics about doing a role, and there's lots of ways to do that sort of analytical role, the computation for an analytical role. In a very simple case, you would simply roll at expiration or maybe 5 days prior to expiration. And a lot of contracts or a lot of products on the futures markets do actually roll that way. They just don't have the volume or the liquidity to do any sort of analytical role. But certainly some things, like E-mini contracts in the as an equity index, or crude oil is a commodity, they have sufficient volume that you have the ability to then look at various aspects of the market, like a trade price or trade volume, either on the individual contract that front month, or in combination with the front month and the back month, or in combination with open interest, right? So all these contracts, especially the ones that trade heavily, will have an open interest at the end of the day, so you can kind of get a sense what is the market's interest in participating in that contract. And then as you get closer to the expiration, that will typically start to decline in the front month. And so the trick when it comes to rolling is knowing when to roll. Again, you can rely on a data service, which will have sort of predefined concepts or methodologies to actually roll. But if you want, you can do this kind of thing yourself. And I'll show some examples of that as well. And one last aspect when it comes to rolling is known as back adjusting. There's various aspects of this roll methodology when you want to adjust the prior prices such that you have a smooth price curve through history. So typically you're looking across a time horizon of a year or multiple years. And these contracts are going to trade at different prices. So when the roll occurs, you don't necessarily want to have this gap or jump in price. That's known as the roll gap. So you want to figure out how to flatten that or adjust for that. And that's what's known as back adjusting. So you're looking at the most recent contract in maybe a long time horizon, and then you want to apply at each individual roll, from the March contract to the June contract to the September, then the December contract. You want to apply a back adjustment that closes that gap of the price between each one. And again, I'll show some examples of that as well. Let me share my screen. So this first one I'm going to show here, I'm just showing here, if you can see this, simply a plot line of 4 individual contracts. Again, this is the E-mini through its lifetime in 2023, right from the March, June, September, and December contracts. And this is a time horizon of roughly a year, not quite a year, because in the year 2023. And I'm looking at essentially daily data. I'm just looking at the close. Obviously, you could do this against settlement prices too, because that's an official published close from each exchange. But I'm just simply looking at the actual final print on each trading day here. And so what you see here, the fact that this is going from January all the way to essentially this week, is how each contract trades through this 1 year time horizon. And you can see where certain contracts start, right? That one there that's in purple is the December contract. And it starts just about the middle of January, and its expiration is all the way at the end of the year. But some of these others you can see, like here's one right here. That would be the June contract when it ends, right? And you can see gaps in the price between them. And then finally here, this last one, when we go from the September to the December contract. But again, these are looking at essentially, well, I'm looking at just simply the close, the daily close of a series that these are not spliced together. These are just the individual contracts and how they trade over a long time horizon. And without any sort of data preparation or rolling or splicing of this data, this is how you would see it. Again, these are the actual traded contracts on the exchange. But when it comes to this idea of a vendor or data service provided front month contract, the synthetic name I was describing, we do supply that, we do support that. And this is essentially where, or any data provider that offers this, we're predetermining what is the time, what is the conditions by which we're going to roll from one to the other. And we do document that as part of our overall futures data offering, how we do that roll. That's this column E here. So for a given set of products, you can see what exchange they're on, what they are. We just simply describe here this idea. Most active simply means when trading volume in the back month exceeds trading volume in the front month. Some things are too thin to roll, so they simply will roll at expiration. But in this case, I'm using E-mini. That's our synthetic name right there, that ESR for rolling. And this, what you see up here is the same idea, right? You're simply seeing an open, high, low, close. But what you're actually querying in this data preparation stage is that synthetic name, ESR. And then the logic says, well, when are you starting it and when are you ending it? So that what that means is we know what is the front month contract, right? And this is the March contract. And you'll see that symbol name there change as I walk through. You can just see it change. So there's a roll date that occurs right there. And then what you're seeing here is this continuous price curve plotted with that synthetic name. And as we hit that date, right there in March 13th, that's when the roll kicked in. And this is the most active roll. So when the trading volume in the back month, that would be the June contract, exceeded the volume in the previous month, the prior front month, which was the March, we will just sort of naturally roll that thing. So you get this nice time horizon price curve. And again, this is important when it comes to looking at this data over long time horizons, typically for a back testing case. And this is back adjusted as well. I can actually show that here. That's an adjusted. Again, that idea of closing those roll gaps so you don't see a jump in the price here as this plot is shown over time. And if I'd have shown it unadjusted, you would see that. You would see how the gaps that occur in that. So again, that's two cases here. That's just simply look at the individual contracts. And in our case, a vendor supplied synthetic name, again, like the idea of Bloomberg or Refinitiv offer this. There's plenty of other data services provide this. And it kind of gives you that sort of in the box preparation and prepared data step in that data pipeline, as my colleague John was describing. So you at the far end doing quant analysis or nowadays machine learning analysis, you're starting with data essentially already prepared in this manner to do that. If in fact you want to go a little bit further, it is possible to do it yourself. The idea of coming up with a roll methodology on your own. So you're going to start with the individual contracts like I showed, but now you're going to look at market conditions, either, and again, thinking of all those different ways that data can be pulled together between aligning and interleaving. That's what this case is. In this case, we're actually looking at the same idea, those same E-mini contracts over a time horizon of a year. But now how and when we decide to roll, that's, you can see the color change here is when we roll, is actually based on an open interest analytic. Again, this is sort of a custom roll methodology here. So the technique that I employed here was simply to look at the change in open interest up to 5 days leading up to the expiration of each contract. right? So if the March contract, I don't remember the exact day, but say the March contract expires on March 15th, starting March 10th, it looks at the change in the day-to-day open interest. And when the change is 20% or higher from the previous day, that creates a trigger condition. That's the roll trigger. So now it's going to roll based on that analytical logic. I'm sure it's some of you out there have done something similar or interested in doing something similar where you're looking at, as I said, just this idea of looking at open interest. You can look at any kind of ratio between the two contracts, the front month, the back month, whether that's volume, a difference in volume. But in this particular case, I use open interest to be able to demonstrate the ability to roll based on some custom logic. And why would you want to do that? I mean, in most cases, you want to roll a position from one contract to the next, from the current front month to the next front month. And you want to do that ahead of the market. If everybody's relying on the same methodology to roll, yeah, it's, the trick is deciding when to unwind a position in the current month, the current front month, and establish a new position in the back month. And if you can get ahead of the game, you can definitely come up with a better price model for that. And I think I have this, I'm just showing this is back adjusted. If I do adjusted prices, you'll start to see gaps in this data right there, right? So that's before, you can see it right there. That is before that back adjust was applied to this thing. And again, the idea of a back adjust is to fill in that gap at roll, right? So when we're coming up with a trigger condition, like the example I just said, looking at a 20% drop in open interest 5 days prior to expiration, as soon as we trigger that condition, whatever day that was, then we have to determine or compute the price difference between those two contracts. And that is our back adjust roll gap difference there. I'm going to have one last example. I just want to show, if you remember, I talked about that idea of contango and backwardation. It's also possible to essentially look at that in, I think it's more applicable in general to the commodities market. Something like crude oil or oil, when you have this contango situation, and that's where the prices, it's a formation really that occurs when prices are higher in the back month than they are in the front month. And like I said, this is typically in something like a commodity like oil, when the market is oversupplied and the demand is low, and the market doesn't really need all that oil being produced, as an example. The opposite of that is backwardation. It's where the front month is higher than the back month, creating this sort of downward price curve. And I'm just simply calculating the spread here, and I use that as the trigger to determine whether I'm in backwardation or contango. And you see these sort of symbol pairs here. This is in time, it's the pairing of the individual contracts with as they would exist or transition or roll in the market. Like the G would be February, then it would roll to the March contract. And again, as you walk through time here, you'll see how each of these pairings eventually will change through time as one rolls to the next. And then you can essentially determine, again, that idea of contango or backwardation is simply, is it a positive or negative spread on those two contracts through time. And I just simply plotted this thing. So things below the line are backwardation, things above the line are contango. Anyway, that's it. Thank you. I think I'll hand it back to Justin.
Louis and John, thank you so much for an excellent presentation today. We're now going to move on to the Q&A part of the webinar. So our first question here today, how exactly do you allow for rolling data in a data series? At the expiry of one contract, do you have to insert the data of the next contract? Louis, John, which of you like to take that question?
Could you repeat that? I'm sorry.
Of course, yes. How exactly do you allow for rolling in the data series? At expiry of one contract, do you insert the data at the end of the next contract?
Well, let me just take this. I mean, Louis, can give you a little more detail on the rolling, but so we call this splicing because we stop the data from one and then we start the data from the other. So the factors he was describing is the ratio across that day, but the data doesn't overlap. So we're just picking out a range and we're sticking it together. Now, it's important to note that the previous contract may still be trading. It may be trading a little bit thinly. We're ignoring that. So the splice operation is we take one set of data, we end it at some point, and then we stick on to that a different set of data. So we go from one to the other at any one given time. Data is only coming from one particular contract.
Louis, is there anything you'd like to add to that?
No, I couldn't have said it better. Thanks, John.
So in the course of doing the webinar with Louis and John, I wonder if there's some other questions the audience might have, or John, Louis, there's some other things perhaps we didn't include in the webinar you want to mention now, some of the nuances and details.
Well, one thing I think I'll mention is that, there's been so much interest over the past year with these large language models and ChatGPT and everything. I think in the future, we're going to see these kind of tools being able to do a lot of what we're describing today. I see kind of in the future, you'll be able to describe how you want your data set laid out or what operations you want to perform. So, like we said at the beginning, we like to think in terms of you might have a lot of steps that you have to do to get to where you're going. But if you break it down into the components of, filtering, sampling, aligning, stitching, those are basic operations and you'll do a bunch of those. But I think you'll be able to describe, we've seen how well you can, have a large language model write code. And I think in the future, you'll be able to say, like, I want to see this column and this column, and I want to line up these series. So I think that's going to be really interesting and useful.
To learn more about OneTick, please visit onetick.com or email us at info@onetick.com. Thank you for answering questions, John and Louis. And thank you for all the preparation that went into this. To learn more about OneTick, please visit onetick.com or email us at info@onetick.com. And we look forward to seeing everyone on the next webinar. Thank you so much.